I was warning about the 2008 financial crisis before it happened. Well, I can assure everybody today that the crisis that's coming is going to be far worse.
Peter David Schiff is a stockbroker, financial commentator, and radio presenter from the United States. Before the financial system was hit by a severe crisis in 2008, Peter Schiff predicted it. Also, he has revealed his strategies on how to protect themselves during the financial crisis. Americans are making more money, but inflation is eating into their gains. Peter Schiff discussed the extraordinary drop in real incomes and how it'll ripple across the economy in his podcast. In March, average hourly pay for manufacturing and non-supervisory workers increased by 6.7% year over year. That sounds fantastic until you take inflation into account. With the Consumer Price Index, or CPI, at 8.5% according to official government figures, actual salaries for these workers have fallen by about 2%. Their higher salaries aren't even enough to keep up with rising costs. Wages are rising at a rate of about 4 to 5% per year. As a result, real wages are falling even faster in aggregate. It's even worse according to Peter. The wage figures are accurate because they're easy to measure. Those are genuine figures. Hedonics does not exist. There are no alternatives. The wage raises are correct. The price hikes, on the other hand, are not. Because real incomes are dropping at an unprecedented rate if inflation is actually 17 or 18%, not 8.5%, and wages are only expanding by 4 or 5%. The consequences of falling real wages on American savings may be seen. In 2022, the U.S. household savings rate plummeted. It's currently lower than before the COVID stimulus and PPP checks were sent out. Because the government sent everyone a large sum of money in late 2020 and early 2021, there was a significant increase in savings. People paid off their credit cards and put money in the bank. Savings are being depleted, and people are racking up credit card debt at an alarming rate. Consumer debt is at its highest level since 2001. Not only are their savings gone, but they now have fewer savings than they did before they received the government slush fund, since they spent it on rising costs. Now that money is gone, they're dependent on credit cards to bridge the gap between their earnings and their expenses. Peter emphasized that the drop in real earnings for American households is unprecedented, and it'll have ramifications for the rest of the economy. They have to make cuts wherever they can. To put it another way, people will strive to save money. The Netflix subscription will be canceled. They're refusing to take a holiday. They aren't going to eat out as much. This is terrible news for an economy based on people spending money on things they want. This, according to Peter, would spill over into the stock market, especially on the NASDAQ, where companies are valued for growth. They're not just not going to experience growth, they're going to see a decrease in their business. As a result, the equities are priced for perfection, but we're getting the polar opposite. All of these equities are still expensive, therefore they have a long way to fall. However, because results aren't even close to estimates, these stocks need to be marked down significantly. Furthermore, the Fed claims that tightening monetary policy and combating inflation can be done without harming the economy. The economy, according to Federal Reserve Chairman Jerome Powell and certain other central bankers, is robust enough to handle higher interest rates. According to Peter Schiff, this is simply the latest in a long sequence of arrogant Fed miscalculations. Some economists are concerned that the Fed will make a mistake and tighten too much as it begins to raise rates and deplete its balance sheet. However, Peter claims that the Fed had already made the error. It's not about the Fed making a blunder. They've already made numerous errors. The Federal Reserve has never done anything correctly. They've already condemned us in the future since they've made so many blunders in the past. It's not about any potential blunders they might make. It's about the previous errors they've made. And given all the mistakes that central bankers have made in the past, Peter believes that more mistakes will be made in the future. In the future, the mistake they'll make is not tightening too much, but not tightening enough, yielding to political pressure once the economy truly begins to tank and the markets are entrenched in bear market territory. When the Fed takes its foot off the brakes and throws it back on the pedal, the economy is on the verge of collapsing because inflation will spiral out of control. Peter alluded to the recent drop in speculative stocks, claiming that it was a result of the Fed's previous blunders. The Fed's most reckless of all monetary policies, which produced the mother of all inflation, reached peak insanity in 2021. Now the Fed is attempting to put the genie back in the bottle. It refuses to own any responsibility for letting the genie out of the bottle. It tries to pin everything on Putin. It wants to blame COVID for everything. However, it believes that repairing the damage is a straightforward operation. All they have to do now is raise rates to 2.5 or 3%, and because we have such a robust economy and a super hot labor market, the Fed can do now what it couldn't do in the past because the economy is so much stronger now than it was then. It's not, however, more powerful. It's just a bigger bubble, says the narrator. However, the Fed's central bankers appear to be unaware of this. In fact, the only thing greater than this bubble is the FOMC members' egos and their lack of understanding of economic realities. The Federal Reserve has a dreadful track record. Jerome Powell, the chairman of the Federal Reserve, has been stupid, false, and more totally incorrect. Powell isn't the only one. The Federal Reserve has a long history of falling short of expectations. In 2006 and 2007, the Federal Reserve asserted that the housing market was fine. Don't worry, it's restricted to subprime. Central bankers declared when it became evident there was a problem. When the financial markets plummeted in 2008 and the Fed began quantitative easing, Ben Bernanke stated that the central bank was not monetizing debt and that it would sell all the bonds it had purchased once the crisis had passed. They claimed that printing trillions of dollars would not cause consumer prices to rise during the pandemic. They assured that inflation would be temporary when it appeared. They've now admitted it's not temporary, but they're certain they can repair it. They claim that rising rates will not harm the economy. So what makes us think we should believe them? Peter believes it's a case of 3 strikes and you're out. Strike 1, subprime is under control. Strike 2, inflation is just temporary. Strike 3, we have the ability to hike interest rates. It won't be a problem because the economy is robust enough to withstand it. When that error is discovered, I believe the Fed's credibility will be shattered. In addition, GDP shrank in the first quarter. The stock market has been in freefall. The inflationary fire is still burning. This all points to a recession, as Peter Schiff noted in his podcast. Despite this, the Federal Reserve is on the verge of raising interest rates. I'm not sure how this is going to work. Stocks had a horrible day on Friday, capping off a bad month for stocks, especially the Nasdaq. It was dubbed the tech wreck by Peter. Before the year started, Peter was warned about the effect of rising interest rates and inflation on IT companies. The Nasdaq fell 4.4% in a single day on Friday. The index was down 7.3% for the month. The Nasdaq had its worst month since November 2008. The worst recession since the Great Depression was just getting started. And the Nasdaq experienced a month like this the last time. But there's more to it than that. The Nasdaq has lost 17% this year. Since the Nasdaq was founded in 1971, this is the worst first month of any year. So we had a horrible bear market during the stagflationary decade of the 1970s, but we just had the worst first 4 months of the year since 1971, says the author. The Nasdaq has fallen 23.4% from its high, putting it in bear market territory, and all 4 FANG stocks have now fallen into bear market territory. Following the release of decimal earnings data, Amazon had a bad day on Friday. According to Peter, Amazon's issues are only beginning. The United States of America is bankrupt. Amazon earns money by selling things to people all throughout the world, not only Americans. Consumers, on the other hand, are broke. They spend an excessive amount of money on food. They're overspending on gasoline. The majority of consumers do not shop for food or petrol on Amazon. They use Amazon to buy other items since they don't have any money left over after paying for food, energy, and rents. How can the Fed still be confident that it can raise interest rates without causing a big recession, given the economic statistics and stock market weakness? In Q2, we might easily see another negative GDP report. After all, no one predicted it in the first quarter. That would formally usher us into a downturn. What if the Fed raises rates in the midst of a recession? How terrible will the downturn be? If things are this terrible now, with interest rates at 0.25%, how much worse will it get if interest rates go up? It amazes me that people are so unaware of the threat of recession and how the Fed can be so optimistic, given how bad the numbers are already, that rate hikes won't cause a recession because the economy is so much significantly stronger than it has ever been in the past or at any point other time when the Fed has hiked rates, when objectively the economy has never been this weak. Low unemployment is the one indicator of economic strength that anyone can point to, and that is subject to change at any time. So that brings an end for today's video. Thanks for watching. If you enjoyed it, please like, share, and subscribe to our channel for more such great content.